this section, we're going to be talking about other taxes, payments, and refundable credits on here. So this is in our tab H of the 4012. So again, we've hit our non-refundable credits. So if our taxpayer, if they qualify for any of those non-refundable credits, it has reduced their tax liability as close to zero as possible. So again, like I said, other taxes outside of their tax liability, which was already calculated, it's going to increase now their tax liability. Payments are going to reduce it, and refundable credits will reduce it, hopefully producing a refund or reducing the amount due. So other taxes. So these other taxes are different from the income tax. From the tax tables are figured using the tax computation worksheet. So that's so far what we've talked about. That is what TaxSlayer has computed for us. We have talked about the self-employment tax as we've talked about income and adjustments. So we're going to hit on that again. That's part of other taxes. Not so much the Social Security, Medicare taxes on tip income. We'll cover that just a little bit, but we really don't see that at sites. But that is if there is tip income that has not been reported on any of the source documents. We've talked about a little bit about additional taxes on IRAs and other qualified retirement plans, so those 401ks, pensions, and we've hit on just a little bit the retirement of the first-time home buyer credit. So these amounts are usually calculated on their own form or schedule and entered on the Form 1040 Schedule 2. The taxes are added after the non-refundable credits are calculated. The non-refundable credits do not reduce these other taxes. So the first one is the self-employment tax. Again, these are for our sole proprietors, our contract workers, those who have had that 1099 NEC, or they had that 1099K, or they filled out the form that we provided them with their income and expenses. Again, they're not like those W-2 employees who have had federal taxes, Social Security, and Medicare taxes withheld. So they're subject to the Social Security and Medicare tax for the employee and the employer. Again, once we entered in their income and their expenses, if they had a net profit of $400 or more, the TaxSlayer has calculated the self-employment tax for us on there. So we're just needed to, again, to understand where it is listed on the tax form. If they have self-employment tax, it's going to produce the Schedule SE. And we're also going to see that on the form on the Schedule 2, and we're going to see it reflected on the 1040. So it is similar to the Social Security and Medicare taxes withheld from the pay of most wage earners, except self-employed individuals pay both the employee part and what would be the employer part. Parts of the SE they contribute to the taxpayer's coverage under the Social Security system. So typically, as W-2 employees work and as they pay, all of this information is getting transmitted to the Social Security Administration office. But for those self-employed individuals, Social Security Administration doesn't have any of their information until they file the tax return. So they file their information to the IRS, then the IRS submits that information over to the Social Security Administration office. So I knew some years back, as I was working, that the Social Security Administration, typically they used to they would mail out your annual earnings, or you could kind of see possibly what you would qualify for retirement. Now you can see that if you create an account, so those self-employed individuals, they can create an account on the Social Security Administration and they can see what is reported annually. And this should match to what's on their tax return. We've talked about these, so the IRA and qualified retirement plans. We talked about if a distribution is taken before the taxpayer reaches 59 and a half, if it's not rolled into another qualified plan, another 401k or IRA, and no exception applies, the taxpayer is subject to a 10% penalty of distribution. So TaxSlayer is already going to calculate that 10% penalty for us if we get that 1099-R form and we see that it has a code 1 in box 7. So code 1 means it is an early distribution. If it has a code 3, we know that's disability. That's already been taken care of for us. So this is those 1099-R, box 7, code 1. That means we have to ask the taxpayer, what did they take, what did they have to make the distribution for? We don't give them the exceptions. We just ask them, why did they pull the funds from their retirement plan? And then we go and we look at our chart to see if it qualifies for one of those exceptions. So if we look on page H5, it gives us a list of exceptions that we can possibly waive that 10% penalty. Again, taxpayer is going to already calculate the 10% penalty. If they qualify for one of these exceptions, then we have to go in the system to remove the penalty. So you'll see we have these numbers on here. There's one for qualified retirement plan distribution. If you separate it from service in or after the year you reach the age 55. Distributions made as part of a series of substantially equal periodic payments of your life or the joint lives of you and your designated beneficiaries. Distributions due to total and permanent disability. Distributions made on or after date of death. Qualified retirement plan distributions up to the amount you pay for unreimbursed medical expenses during the year minus the 7.5% of your adjusted gross income. Qualified retirement plan distributions made to an alternate payee under a qualified domestic relations order. IRA distributions made to unemployed individuals for health insurance premiums. IRA distributions up to the amount you pay for higher education expenses during the year, unless paid with tax-free education aid or Pell Grant. Look at this one, because number 8, we're going to use that one for our scenario 8. IRA distributions made for the purchase of a first home up to $10,000 per taxpayer and paid within 120 days of distribution. Distributions due to a IRS levy on the qualified retirement plan, and qualified distributions to reservists while serving on active duty for at least 180 days. And then they have this little code other. You're going to see some more on your page 4012. And also take special note of code 7 to 9. Those are only for IRAs that they can get this exemption. So it has to be an IRA in order to qualify for the higher education, to use it for higher education expenses. How do we know it's an IRA? That 1099-R, box 7, until that part of that box 7, it lets us know if it's an IRA, SCP, or simple plan. That box is checked. So these are exemptions where we could waive the 10% penalty. And so we would go into tax layer. And let's see if it shows it. Yes, we go into tax layer under the federal section. We're going to look for form 5329 with those other taxes. And then we go to part 1. We're going to see the additional tax on early distribution. Who does this form belong to? The taxpayer or spouse? We don't really see any simple retirement plans, but this says early distribution that are not subject to tax. So of the amount of their distribution, how much did they use for whatever exemption? So like scenario 8, I believe we saw in her 1099-R, she had a distribution of $2,500. Of the $2,500, did she use it all for educational expenses? If she used the full $2,500, then we're going to put that here. That early distribution amount, not subject to the 10%, and then select the reason. Then we're going to find that higher education expenses. And tax layer is going to take that amount out. They're going to figure out that 10% tax based on the $2,500 and remove that tax. Then we have our HSAs, health savings accounts. Remember, we talked about if they do not use their health savings account for medical, dental, or vision, they take that distribution and they just use it for anything else, That HSA distribution amount, it is being reported as income. Whatever has not been used for medical, vision, dental, that amount becomes treated as income, and they're subject to a 20% tax. The tax layer calculates. So how does this get calculated? When we completed the adjustment section. When it asks for the distributions on that HSA form, that 1099 SA for distributions, it asks for the distribution amount. And of that distribution amount, what was used for medical, dental, vision? What was used for medical purposes? It's going to take that difference. It's going to move that difference over to income, and then it's going to calculate 20% of that. There are exceptions if a person passes away, if they become disabled, or once they reach 65. So this was actually something that I found out from actually a veteran volunteer that's older, which is why I'm telling you it's good to get an HSA plan. Again, because it is pre-tax, treated like a 401k, and it gets the 401k treatment once you reach the age of 65. You no longer have to use it just for medical, dental, vision. You can use it as a 401k plan. You can just get pulled from it regularly. Then we have the first-time home buyer credit. So we talked about this credit are for those individuals that purchased their home, bless you, in 2008. Generally, they must pay the credit over a 15-year period in 15 equal installments. So the repayment period began in 2010. So they're almost done, 2025. They're almost done with this. However, if the home ceases to be the taxpayer's main home before the 15-year period is up, they have to repay the remaining annual installments. So we talked about the sale of a main home. If they got their home in 2008 and they got this first-time home buyer credit, then those remaining payments, that would become, all of it would be listed on their other taxes. If a person doesn't know, typically they bring in their prior tax return, or we can look up what is their annual installment on the IRAS.gov, and we type in the search bar, first-time home buyer credit. If it is a taxpayer and spouse, they actually split up the credit. So the taxpayer is claiming a portion and the spouse is claiming a portion. And typically their amount should be the same, but we can also go to, again, if they don't have a prior tax return for us to look at, we can go into the IRS system on IRAS.gov and look that up. And of course, we can look it up with their permission, of course. So as they're sitting at our desk, we can ask them, hey, do you allow us to pull up that information for you to make sure that it is correct? Then we have the excess advance premium tax credit repayment. So we talked about some individuals may have to go to the marketplace exchange, which people also know it as the Obamacare, to go and find health insurance. These individuals also, they may, based on the income that they've provided, because they are providing an estimated income that they would make for the year, they may qualify for a subsidy on there. So if someone on the return had health insurance for it any time during the year through the marketplace, they will receive a Form 1095-A. If the advance payments of the premium tax credit were made for coverage of the taxpayer or dependent, the taxpayer must complete the Form 8962. So this is for anybody listed on the tax return. So it could be maybe the taxpayer has coverage through their job, but maybe the dependents are getting health insurance through the marketplace. Or maybe the spouse is getting health insurance through the marketplace because it's more expensive at their place of employment. But anyone that has coverage through the marketplace, we need a Form 1095-A. Even if they only had coverage for one day out of the year and they decided not to move forward, or coverage for a month, we need this Form 1095-A. If they don't know if they had health insurance through the marketplace, there's a number that we provide them through the healthcare.gov that they can call to see if they had health coverage. Advanced premium tax credit, if their income is greater than what was reported to the marketplace, their advance premium tax is greater than what it should have been. So again, we talked about that they have to give an estimate of their income. So they actually made less in 2021, but they got a bonus or increase in salary for 2022. Did not call the marketplace exchange to report that. That means their subsidy was greater. More than likely, they're going to have to pay some of that back. And this is where those other taxes come in. So how do we determine what they have to pay back? TaxSlayer is going to calculate that for us when we enter in that 1095A. It's going to populate the form 8962, and then it should be within these ranges. You're going to see if their income was under the 20% of the federal poverty line, between 299 or 300 to 399 or 400 and above, based upon their filing status, this is where their repayment gets capped off at. So say, for example, a person under the 20%, 200%, and they actually received $1,000 more in subsidy, but they're single. Instead of repaying the full $1,000, it's going to cap it at the $325. That's going to be populated on the tax return as other taxes. So this chart tells us this is what their repayment will be capped at. And again, this is if their subsidy is greater than what they should have received. So our payments. The federal income tax system is a pay-as-you-go system. That means taxes paid as income is earned or received during the tax year and is referred to as a withholding credit. So we see withholdings on a W-2, a 1099-R, the W-2G, so the gambling winnings, unemployment, and there's a few other forms where they typically withhold. So your W-2, your withholdings is based upon your W-4. When you first start your job, you complete a W-4 that determines the taxes, federal taxes that are withheld from your income. A 1099-R, you may have to complete that W-4 as well, or it could just be going based off of your filing status. The same as a W-2G, we talked about unemployment income. You have an option to opt into the 10% or have nothing withheld at all. Now your interest income, dividend income, your 1099B, so those mutual funds, stocks, and bonds, they do not withhold taxes. So it is up to you to have them to withhold, or you're going to have to submit an estimated tax payment into the IRS, or it gets reconciled when you file your tax return. So many taxpayers have income from self-employment, dividends, interest, capital gains, rents, and royalties. The pay-as-you-go system also applies to this income. If the tax due on this income exceeds certain limits, estimated tax must be paid quarterly by the taxpayer. If the estimated tax payments are not paid when they are required, a penalty could be imposed. So the IRS wants them to pay at least a quarterly tax. Again, this is if we file their tax return and we see that they have an amount due $1,000 or more, then that means they should have paid an estimated tax. If they have a balance due of $1,000 or more, they're going to get hit with a penalty, again, for not submitting estimated tax payments. Again, estimated tax payments, it's called estimated because you're using your prior year information, or you're estimating based on how much you think you would bring in for that year, and you're paying the taxes on that and submitting it quarterly to the IRS. So they can do it sooner, they can do it monthly, but the IRS requires it at least quarterly. Taxpayers who overpay their income taxes in one year can apply all or part of their overpayment to the next year's estimated tax by indicating the amount they want to apply. So you do somebody's 2022 tax return, they're self-employed, and they find out they have a refund. Maybe they get a refund of $2,000. They do have the option of that $2,000. They can apply that to their 2023 tax return, which becomes an estimated tax payment. They do not have to apply the full 2,000. They can let us know. Maybe apply 100, 500, 1,000, whatever. They can choose and let us know how much they want to apply to the following year. And we're able to input that in TaxSlayer. The remaining amount, they can receive that as a refund. They can receive it as a refund from a direct deposit or check, or they can buy a savings bond. So they do have that option. Taxpayers can get an automatic 6-month extension from the time to file by submitting Form 4868. This is the application for automatic extension of time to file. This form extends the time to file until October 17th. This is only an extension to file, not an extension to pay. So if somebody owes, we did their taxes and they still don't want to file, they still need to pay by April. Sorry, I said 17th thinking that was the deadline, April 18th this year. So the deadline sometimes changes. We always have in our mind April 15th, but if the 15th hits on a weekend, it's going to be the following business day. If there is a holiday in DC, then it's going to be the next day. So I think there is a holiday there, which is April 17th, so that's why the deadline is April 18th. So they have to pay their taxes this year by April 18th unless they will owe interest and be charged penalties. So typically for the extension at our site, because we're so busy up until the April 18th deadline, we typically just print copies of the 4868. All that form is going to ask for the taxpayer and her spouse, their name, their social, their address, and then to the right of it, what they think their tax liability is, and if they want to send in a payment with this automatic extension form. And as long as it's postmarked by April the 18th, their extension is good. The main post office off of 30 in Sylvan, I don't know what other post offices, that post office in Dallas, they're open till midnight, accepting all tax forms to make sure it does get postmarked by that April 18th date. So when we're talking about some of these credits where it says they can up to file an extension like the American Opportunity, if somebody has an I-10 or they don't have an identification number, if they file an extension, they can then qualify possibly for one of those credits that we talked about. So we talked about the I-10 holder. For them to qualify, for their dependent to qualify for the child tax credit, they have to have a social. Maybe somebody's going through the process of applying for a social and they say that they probably won't get it until maybe August. Well, we don't want to file anything for them by the April 18th deadline. Let's file an extension. So they have until October 15th to file a tax return. They get that social by August. That means they're qualifying for the child tax credit for those dependents. Those dependents get their social, they're qualifying for the child tax credit and possibly for the earned income credit, which we're going to talk about. So this is the automatic extension. Is a six-month extension, again, for time to file, not for time to pay. And at our site locations, we're typically only issuing out the paper to the taxpayer so they can file this extension. So when we get into TaxSlayer and we look under the payment section, we'll see if a self-employed individual said that they made estimated tax payments during the 2022 tax year for their 22 taxes, we need to input that in. And we do, I know at North Dallas, we do have a few clients that do estimated tax payments. So we'll go under payments and we'll go to federal estimated tax payments and hit begin. It's going to have those 4 quarters on there. So I think it's April, July, September, and January. So the last estimated tax payment for 2022 is due this month. And even if they made more than 4 payments, we still go by those dates and we'll put those payments in the system. Apply overpayment to next year's taxes. We've completed the tax return and we see that they have a refund. So they want their 2022 refund to go to their 2023 tax return. Again, we can split that up. We can go to apply overpayment to next year's taxes, and input whatever amount they choose into the system there. Amount paid with extension. Maybe we're doing somebody's prior tax return. This would not be for the 2022. Maybe we're doing somebody's 2021 tax return and they actually did an extension, which the extension time has already passed for them, but they actually made a payment with that. We can go in the system and put that amount in there that they paid as we prepare their prior tax return. Also, maybe for a self-employed individual, because they did estimated taxes, and once we do their return, they may want those vouchers for the following year. So even though it says 2020, in your book, you should see on H7, 2023, it will allow us to print those vouchers for the 2023 tax year based on their 2022 information. So we're going into our refundable credits, and we have the additional child tax credit. The additional child tax credit, it is the child tax credit, but that's the child tax part is the non-refundable, but some individuals may be entitled to a refundable additional child tax. So this is kind of like an add-on portion of it. Taxpayers with more than $2,500 of taxable earned income may be eligible for the additional child tax credit if they have at least one qualifying child. And most of our clients do qualify for the additional child tax credit. Taxpayers with 3 or more children may be also eligible for the additional child tax credit regardless of their income. So again, this is refundable credit. So even if we have reduced their tax liability to 0, they qualify for this credit. This is money in their pocket. This is a refund that they're going to receive. The additional child tax credit is limited to $1,500 per qualifying child. Sometimes you're going to have clients that come in and say, well, my refund changed. I got more last year or less last year. Why? Because our tax rules have changed. And as you get used to it, but when I come and review the return with them, I'm able to let them know, hey, the child tax credit, it decreased again. The amounts were more for 2021 for COVID. They went back to pre-COVID amounts. The additional child tax credit for 2020 and prior was $1,400 per qualifying child. So they did go up a little bit for 2022. So you don't have to worry about calculating this. Again, TaxLawyer calculates this credit. Once you put in the dependents information, your income, the income information, it's going to calculate this additional child tax credit. Just knowing that it is limited to the max of $1,500 per qualifying child on the tax return. We have our earned income. So we're going to go over this one up to, actually what we're going to do is, because the earned income credit, I forgot how many slides. We're almost done with our training. We're actually going to stop here at the earned income. I don't want to get into it and the food comes and we can't go into it. So we're going to take a early break right now. Do we have any questions? No questions? Okay, so after we come from lunch break, we're going to go into earned income credit. Then we should be wrapping up the tax return, and we're going to go back and complete our advanced scenario 8. And then because we will be wrapping up early today, it'll be optional for those that want to stay and complete your other scenarios, 7 and 9, as well as I'll get a list of those individuals who are interested in the 1040 NR, who are interested in doing those non-resident returns, and I can send a link out to you with that training. So we left off talking about the refundable credit earned income. And this is a very big credit and special credit definitely for our clients because quite a few of them are able to qualify for this credit. They did make some provision changes for the earned income credit last year, but they've changed back to what they were originally for 2022. So the earned income credit, we're going to say hence the name earned income. It is a refundable tax credit for most people who work but do not earn high incomes. So somebody has to have earned income. It cannot just be unearned like interest income, dividend income, unemployment compensation. They have to have earned income, W-2 income, self-employment income to qualify for this credit. The purpose of the credit is to reduce the tax burden and to supplement the wages of working families whose earnings are less than the maximums for their filing status. Eligible taxpayers can receive a refund with this credit even if they have no filing requirement, owe no tax, and had no income tax withheld. All taxpayers and dependents must have a valid Social Security number by the due date of the return, including extensions to claim the credit. So this is going back to who must file, that chart D, who should file. A person, even though they do not have a filing requirement, will want to file a tax return if they have a qualifying child that's going to get them the earned income credit. We would recommend that they would file a tax return. Also, everyone on the tax return, taxpayers and dependents, must have a valid social. So I-10 holders, anyone on a tax return has an I-10 that disqualifies the tax return for the earned income credit. But the good thing is, like I talked about, they have to have that social by the due date of the tax return, including extensions. So if somebody's in the process of applying for a social, then we can file that extension, that 4868, giving them to October 15th to file a tax return to get the earned income credit. So on here, we find out what is included, what are some types of income that are used for earned income and what doesn't it include. So we'll see on the left column, it is taxable wages, salaries, and tips. Haven't seen anyone come in with union strike benefits, taxable long-term disability. Those that have the 1099-R in box 7, they have that code 3. Net earnings from self-employment, gross income from a statutory employee, that's that W-2. And box 13, that statutory employee box is checked. We don't have any household employees that come to get their tax return done. Non-taxable combat pay election, those are those military individuals where when they go overseas, they can elect if they want to include, I think that's that box 12 code Q, if they want to include or exclude that income from being taxed. Non-employee compensation, that is our sole proprietors, self-employed individuals. And the rental house, that's out of scope for us. So what's not earned income? Interest and dividends, Social Security benefits, welfare benefits, workfare payments, pensions and annuities, so anything on a 1099-R with the exception of code 3 in box 7, veteran benefits, workers' compensation, alimony, child support, unemployment compensation, taxable scholarship and fellowship grants that did not get reported on the Form W-2. And so they have earnings for as an inmate, disability insurance payments, and so forth. So a person has to have earned income, and we're going to look at those income guidelines in order for them to qualify for the earned income credit. So these are the rules in order for individuals to qualify. This is on the 4012 page I-2. So they have rules for everyone, and then rules if an individuals have a qualifying child, they don't have a qualifying child, and then we're going to take a look at the income limitations. So again, we know everyone on that return must have a social that is valid for employment. So there are a couple of different socials out there that is maybe just for identification. You can see at the bottom of the I-2, page I-2, there are some socials that do not qualify for the earned income credit. If it says valid for employment, that means they will get the earned income credit. Married filing separate, getting that out of scope filing status. It does not qualify them. It excludes them for the earned income credit. So that's why we're going to see if they can maybe file for, maybe if they qualify for that head of household filing status, if they did not live together those last 6 months of the year. They must be a U.S. citizen or resident alien all year. They cannot file Form 2555 related to foreign earned income. Their investment income, so this is those interest dividends, that 1099-B, that income must be $10,300 or less. If it exceeds that amount, they disqualify for the earned income credit, and they cannot be a qualifying child of another person. So those are the rules for everyone. Now, what if you do have a qualifying child? Remember, we talked about the qualifying child is the relationship, age, the residency, the support, and joint return. So the child, for the qualifying child, must meet the relationship, age, residency, joint return test, but not the support test. So that's the one caveat for the earned income credit. The child doesn't have to be your dependent. This is where I talked about those children of divorced or separated parents, the custodial and the non-custodial. If they're going to split it up, the non-custodial claims the child as a dependent on their tax return getting the earned income credit. The custodial parent will have the child for head of household purposes if they have not remarried and will qualify for the earned income credit. A qualifying child cannot be used by more than one person to claim the earned income credit. That example that I said, there's only one of those parents, the custodial parent, that is claiming that child for the earned income credit. And again, the taxpayer cannot be a qualifying child of another person. So those are the rules for if you have a qualifying child, but maybe it's somebody that's filing just a single return, they have no dependents on there. Can they qualify for the earned income credit? Yes, they can if they meet these qualifications. They must be at least 25 years of age and under the age of 65 as of December 31st. So last year for 2021, the age was reduced to 19, but then there was no cap on the age. So somebody 65 or 70, even if they worked a little bit, they qualify for the earned income credit last year. They cannot be the dependent of another person, must have lived in the U.S. more than half the year, and again, cannot be a qualifying child of another person. So what are the limitations, the income limitations to qualify? So your earned income, so that's that W-2 income, your self-employment compensation, as well as your adjusted gross income. So that's all income minus deductions, all income minus adjustments must be less than, it's $53,057. For any filing status with the exception of married filing joint, theirs is $59,187 if they have 3 or more qualifying children. For 2 or more qualifying children, $49,399 for all other filing statuses except for married filing joint, which is $55,529. If they have 1 qualifying child, all other filing statuses, it has to be less than $43,492. Married filing jointly is $49,622. And then if you don't have any qualifying children, so it's just you on the tax return, your income has to be less than $16,480. Married filing joint, $22,610. So those limits, they increase a little bit each year for inflation. And so just because I like to tell individuals when they come in and get their taxes, people assume maybe if their income is very small, maybe if they only made maybe $4,000, they're not going to get the max earned income credit. I describe the earned income credit kind of like going up and down a hill. As a person's income increases, the earned income credit that they get increases. As their income continues to increase, the earned income credit starts to gradually go down until it phases out. So it's going to phase out at those income limits that we just looked up there based on the filing status. The IRS cannot issue refunds before mid-February for returns that properly claim the earned income credit, child tax credit, the additional child tax credit, and American Opportunity Credit. So those individuals that, with the PASS Act, that have any of these credits listed on the tax return, we can start filing their return and submitting it January the 23rd. It typically takes about 2 to 3 weeks to process electronic return. But again, if it has one of those credits on there, the IRS will not start processing it again until mid-February. So they won't see their return until late February, just so they can check. In the past, you know, a person could have claimed the earned income credit and probably had a person on there that was not their qualifying child, should not have been on there. So the IRS, what they're trying to do is just make sure that that these individuals, they're entitled to claim them. So those returns kind of have a little spot check before they get released on there. So what happens if someone claims a qualifying child or claims one of those credits and they should not have? There's a disallowance of certain credits. So a lot of times we don't know, maybe the IRS has reached out and they probably already reprimanded a taxpayer about putting someone on their tax return on there. When we go and submit the return, it comes back flagged that we have to add this form 8862. This means they are claiming a credit after disallowance. They're certifying that whoever that qualifying child is on the tax return, that they live with them more than half the year, that they are their qualifying child for the credit, that there was no reckless intent or disregard for putting that individual on that tax return. This form also is included maybe if someone has claimed a dependent in the past and they're getting the earned income credit and it's just them listed on the tax return now. You don't have to worry about this form. This is already built into our intake sheet, but I can say most people, they always answer no, that they've never had a disallowance. But we transmit that tax return and it comes back that we have to include this form. I will call the tax client and then just go through a few questions with them. So this is making sure that a person does not intentionally, recklessly, or fraudulently add individuals on the tax return that they should not. If the IRS makes the determination, that means a person could be banned from claiming that credit. It could be 2 years or it could be for up to 10 years. And again, that has nothing to do with us. Again, that'll be for the IRS, and once they take a look at the tax return, their determination. In order to reclaim it again, it'll be the form 8862 that has to be completed and submitted with the tax return. Another refundable credit is the Affordable Care, the premium tax. So we talked about the other taxes with the marketplace. Maybe a person, their subsidy, their income increased and they did not call the marketplace to let them know that their income increased. So they were still receiving a high subsidy to pay for their premium. Well, this is the other side. Maybe we didn't provide the marketplace with our income, or we thought maybe we were going to get a bonus or an increase and our income actually stayed the same. Or maybe we actually lost our job for the tax year and we didn't call the marketplace to let them know that status in our employment, so our subsidy was still at the same from when we applied. So this is under the Affordable Care Act. The federal government, state governments, insurers, employers, and individuals share responsibility for improving the quality and availability of health insurance coverage in the U.S. We know that there is currently no penalty for not having the health insurance, but if a person did receive, again, their income decrease and they did not get a change in their subsidy premium amount to help pay for the premium, they are going to get the premium tax credit. So it's pretty much the flip, the opposite of the other taxes for the premium. Again, we would need to have that 1095A form. So if the advance payments of the premium tax credit were made for coverage of the taxpayer dependent, then tax lawyer is going to complete that 8962 form, once we input that 1095A information. The net premium tax credit is income minus the income less than what was reported to the marketplace. So the advanced premium tax credit is less than what it should have been, and they're going to get that credit on their tax return, listed as it's going to be a refundable credit. So question, a taxpayer has interest income of $4,500. His earned income is only $7,000. He is single, has a valid Social Security number, is not the qualifying child of anyone else. Does he qualify for the earned income credit? Yes, he does, because his income is under that $10,300 threshold, that investment income threshold. And again, with these credits, once we've input the form information, again, TaxSlayer is doing the work for us. So it's just making sure that we're knowledgeable of the earned income credit, who's qualifying, maybe if a person doesn't qualify. And maybe they're saying that, oh, I received the earned income credit last year. What are the differences? Maybe we can go and look at their tax return and you have your 4012 pulled up, that their income increase. Maybe a dependent, a qualifying child came off of their tax return. So now they only have 2 qualifying children, which now they have to look at a different income threshold bracket. Jewel and her daughter live with Jewel's brother, Emmett, all year. Jewel earns $20,000 and claims her daughter as a qualifying child for the earned income credit. Emmett is 25 years old and earned $8,500. Is Emmett able to claim the EIC for a taxpayer without a qualifying child? Yes. Ooh, let's see. Is it going out? Oh, okay. So yes, Jewel's daughter is not the qualifying child of Emmett, but he is claiming the EIC for a taxpayer without a qualifying child.